listening to Pre-Market Prep. I'm Brianna Valesky here with my co-host Joel O'Connor. We're joined by Charles Biderman. He's a portfolio manager and chairman for TrimTabs. Charles, thanks for joining us this morning.
Well, good to be with you.
So, the premise behind TrimTab's approach is that stock prices are a function of supply and demand of shares of stock and money rather than fundamental value. Can you explain that to our audience for us?
Sure. All there is in the stock market are shares of stock. There is literally nothing else. And if you look at the market by itself, all that occurs are transactions. So stocks are bought and sold. Money changes hands and shares change hands. So before us, I can't find any history that anybody ever looked at the market. If you understand changes in the amount of shares available and changes in the amount of money available, you'll be able to predict what the market's going to do solely based on supply and demand, having nothing to do with earnings, sales, interest rate, what the Fed does or doesn't do, what the yuan does, or if Google decides to change their company name to Emperor of the World, whatever.
So you don't look at fundamentals at all with regards to these issues?
Well, no. There's absolutely no relationship. I mean, look at the U.S. economy. The U.S. economy is growing 2%. Average number of jobs each month is about 200,000. If you believe those numbers, a job today is not like the jobs before. Back in when the Fed initiated QE3 several years ago, the U.S. economy was growing at 2%, and there were 200,000 new jobs a month, and that was insufficient. So they started QE3. Now we have the same fundamental underlying, and the government has said, or the Federal Reserve wants to raise interest rates.
So can you expand on your take of the overall market right now?
Well, it's pretty simple. Since the end of 2011, if you look at all the money going in and out of U.S. equity mutual funds and ETFs that invest in U.S. stocks, the net flow has been, ready for the drum roll, zero. No new money from individuals. The amount of money that's going in is roughly equal to the amount of money coming out. So why is the market higher if there's no new money coming in? Companies have been net sellers of shares to the tune of $1.6 trillion. Half of that is from buybacks minus all new share sales, and the other half, or $800 billion, is companies buying other public companies for cash. So, for example, yesterday, Mr. Buffett or his company is buying the Precision Castings for 30-something billion in cash. So holders of that company shares will now get cash. So if you consider that in the institutional marketplace, institutions own 80% of all U.S. stocks. When a company is taken over, that means that these whole institutional holders now have more money to chase fewer shares. So let's see, what's going to happen if more money chases fewer shares? I hope I don't have to answer that for your listeners.
So let's talk about some of these specific companies. Obviously, everyone's talking about Google right now. They're restructuring their management, going to have the Google search engine underneath this umbrella company called Alphabet. What's your take on this strategic move?
Well, other than my own funds, I own Google, Amazon, Salesforce.com, Apple, and Facebook. Why do I own those? Because each of those companies created its own demand, and the demand for those products is still growing rapidly. And I think what Google is doing makes a whole lot of sense because they're keeping so they can give out all kinds of direct information about Google, and then it has these venture capital type deals that, whether it's health or automobile, who knows what they're doing, that to create new products that will create its own demand that doesn't exist now. And so they have a laboratory, so the money they spend on that is not considered an expense against the Google that queries on everything, or YouTube or whatever the current revenue stream is. So it's like it makes it a cleaner company, so to speak, to follow. And so I think it's terrific. Besides the fact, of course, I'm a shareholder.
Yeah, that's a great point. Like all of these expenditures they have on research and development for something like Google X or the all of the other ventures they have, that won't show up on the balance sheet for Google search engine and Google advertising and stuff. So that's a great point. You mentioned a couple of tech stocks, and another one that people have been talking about lately that I didn't hear was in your holdings was Twitter. Do you have any interest in Twitter? If not, why not?
Well, one, it's not consumer friendly. I mean, old people like me, I have a Twitter account, but I rarely use it. It's just too, I'm not that interested in what people have to say that I want to hear their, 20 word tweets. I'm just, so unless there's some other, I've been hearing like making Twitter with sports betting or fantasy stuff, or I don't know. But without some new use for it, I think it's a niche. It's very useful for people in the financial world, or those who really need to be socially connected and want to have their nitwit comments heard by a lot of people. But I don't see the value beyond that to even justify its current market cap, unless there's some new products or new innovations or new stuff, at which point I'll reevaluate it. But I just don't see it as something I want to buy.
Charles, taking a look at your ETF here, TTFS. Tell us what that's comprised of. What are we looking at here, and what information will it give the typical average investor when you're looking at a chart of your ETF?
Sure. Well, in the 25 years I've been in business selling research to very smart hedge funds and money managers, and why I say they're very smart, because they bought our research. That's how I know. That's a joke, by the way.
I got it.
That one of the key things we've discovered is that free cash flow is the most important metric there is out there So if you invested in companies that are growing free cash flow faster than the rest, historically, you would have outperformed the indexes. Yes, and that same holds true for companies growing free cash flow outside the U.S., which is what we started another ETF this past June 3rd called TrimTabs International Free Cash Flow, or FCFI. So TTFS invests in U.S. companies that are growing free cash flow and using a portion of that free cash flow, typically 40-50%, to reduce the share count. So that companies, what that means in essence is, if a company ends the year with more cash we actually use a 2-quarter time horizon. A company ends 2 quarters with more cash than it started with, and it has less shares outstanding. We say that the fundamental underlying value of the business should not go down, but because there's less shares outstanding, if the price of the remaining shares doesn't go up, the company would be valued at less than it was before the share count reduction. And so what we discovered historically is that not only are the stock of companies who are reducing share count out of free cash flow, not only is it going up by the amount of the share count reduction, but it's selling at a premium to the share count reduction, which says to me that people like companies that are growing cash and using a portion of it to reduce the share count.
Charles, I'm getting a couple different impressions here. I mean, on one hand here, you're talking about, the stalwarts, in the industry, the companies that have the cash, are deploying the cash in the right way. And sticking with those overall kind of bullish market because lack of supply, lack of new stocks from what companies are doing. But then, like some of your comments that you made, regarding the actual jobs that have been created or the wages, you sound a little bit bearish. So I guess give me your long term and short term assessment of market. I mean, after all, with all the selling we've had over the last few days, I mean, Barron said 7 day losing streak. News to me. What could you give us, like, let's say a 6 month outlook for the market, and then going out a little bit longer term?
Well, before I do that, I just want to reiterate that there is absolutely no relationship between the stock market and stock prices given central bank intervention,
Mm-hmm.
dramatic intervention globally over the last half a dozen years. So in the past, there was a relationship, but right now there isn't any relationship. So the economy, the global economy, is entering into a global recession. Commodity prices keep dropping. The loans that all these commodity producers took out to grow production are delinquent in essence and will be, assuming this commodity deflation continues, there's going to be an awful lot, billions and billions of bad debts on global banks. But then again, government, central banks have been known to print money to save their banker friends from losing their jobs. Heaven forbid a big banker should lose his job because the bank goes broke because they made bad loans. I mean, that's heresy to central bankers. So there is no relationship between the economy. And so in the stock market, as long as companies keep providing more cash with which to reduce the share count, and there's more money chasing fewer shares, stock prices will keep going up regardless of what the economy does. And yes, at some point in the future, reality has to set in. Central banks cannot keep managing the world's markets. I mean, look at China. China learned from everything every other country has done, and so they're now stepping in directly and manipulating the stock market. I mean, it used to be conspiracy theories. Oh, the government's managing the stock market. Oh, that can't be. Well, it is. It's been happening.
All right, so if you take that stance about the government intervention, the quantitative easing to keep the economy slash market going, then you just must be saying no way they're raising interest rates in September, December, or ever.
Well, except if they want to. They could, just because they say they're data dependent. I mean, I remember a few times in the past that government officials or central bankers have lied. Now, I don't know if most people think that's possible, but if they want to raise rates, they're going to raise rates 25 bips. It's not going to mean anything, except it is going to mean something for some. It will slow growth. There's obviously the car sales and mortgage prices. But but the possibility is if they actually do raise rates, you notice that the more Wall Street is convinced, or the bond market, that they're going to raise rates, you see the 10-year flattening. Now, why is the 10-year flattening? Because people think that higher short-term rates is going to mean a slower growing economy and less demand for money. So the flattening yield curve is a sign that, yeah, they can raise rates, but it's not going to help.
Yeah, it's really not going to make much of a difference. We have a variety of different people that listen to the show. We have obviously people that are shorter term traders that are looking to, take advantage of short-term fluctuations in the market. I know that's not your cup of tea, but let's just break down a couple different subsets of people. Just young kids coming out of college, getting their first jobs, starting to invest in the market. I mean, you mentioned those stocks that I think you mentioned just maybe 4 or 5 stocks in your portfolio. Do you think they're better off, going into a small, concentration of stocks? Do you think they're better off going in just like the spider, overall ETF, or do you think that maybe this is a point, well, maybe they should hold back on their investing a little bit, maybe wait for a little bit of a correction?
Well, I'm not specifically allowed to tell others or
Okay.
recommend others what to
Okay.
do, for various legal reasons. So
Okay.
what I would do if I were a youngster is I would buy every month uh, an equal portion of trim TTFS and the U.S. version and FCFI, and that at some point when the market does come in, you want to own companies growing free cash flow. You have less risk on the downside. In the past bear markets have indicated that companies growing free cash flow outperform the rest of the market during down markets. Now, don't know if that's going to happen this time, but I would tell someone to dollar cost average, invest every month, and when the market goes down, keep buying because it's hard to do. Most people who plan to dollar cost average when the market goes down stops buying at the absolute wrong time to stop buying because you want to keep buying when the market's down. Of course, this assumes that the United States at some point in time will recognize that prohibiting growth or hindering growth or creating policies that make it harder for businesses to form, for new ventures to start, is not a good idea. Once we get back to the American principle that, hey, let people create businesses, start stuff, and let's stop hindering them by creating regulations that says, well, hey, you hire someone full time, it's going to cost you a lot more money than if you hired two people. If instead of hiring two people full time, you hire three people part time, and you pay less.
Yeah,
I mean, that's the kind of crazy world we're in now.
Before we let you go, you give us some great macro and fundamental information. I just wanted to go over quickly the stocks that you said that that you're comfortable with that are creating positive cash flow. You mentioned Facebook. I think you
Well,
mentioned.
no, I didn't say they're creating These are companies that I personally am investing in because of their rapid growth and creating demand
For
where
their own
demand didn't, where they're creating their own demand uh, where it didn't exist before, products that didn't exist before, like a Facebook, like a Google, like a Salesforce, like Apple, and like Amazon.
Okay, and then just going the opposite. I mean, I know you mentioned Twitter. You didn't understand the product. You mentioned the perhaps what's coming down the pipeline for some of the commodity stocks. Any other sectors that you're a little bit tepid on?
Well, the global banking system is a charade, given that all their bad debts have been made good by the central banks. Remember that as time goes on, bad debts tend to go higher. But beyond central banks, where's the next? Where's the next? Is God going to bail out the central banks? Because there's nobody left. In the central bank garbage loans or paper that they've printed, people say, hey, wait a second, a U.S. dollar isn't worth what a U.S. dollar was because there's now, 13, 16 trillion of them as opposed to a few trillion not that many years ago. Why should we value the dollar as it is, or the euro, or the yen, or whatever currency? You know what I'm saying? It's
I do. I do. I mean, it's you've given us a very interesting take on the market. We've been on the line with Charles Biderman. He's a portfolio manager and chairman for TrimTabs. He's given, I'd say, a perspective on the market that we've never had on the show, and we really appreciate it, Charles, and we hope to have you on again soon.
Thank you,
well,
Charles.
thank you. Appreciate the opportunity.